Good morning, ladies and gentlemen, and welcome to the BP Marsh Partners PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, if I may, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Chief Investment Officer Dan Topping. Good morning, sir.
Morning. Morning, everyone. Thanks for joining us. We're looking forward to presenting on our results, and I think we'll move straight into the presentation and put it up on screen if we can. Right. Pleased to welcome you all, as I said, to our full year results to 31st January 2023. It'll be myself, Dan Topping, the Chief Investment Officer, and John Newman, our CFO, presenting on these results. We're very pleased with these results, and I'd like to take this opportunity to thank all the members of the BP Marsh team and the wider portfolio for their efforts in allowing us to achieve them. The key takeaways for our results on slide 3. Consolidated profit before tax of 27.6 million, 8.2 million up on our prior year, or 42% increase. Net asset values of 189 million 500,000, 2.9 million increase on prior. And regarding the portfolio, a 19.1% increase in the value of the equity portfolio year on year, providing a total shareholder return for the period of the year of 14.4%. Presently, we've got available capital of 5.2 million for investments. As I said, we're delighted with the overall performance of the group for the year, which is a continuation of our solid year-on-year growth recently during an extended period of wider instability. Given the significant post-year-end events in advance of these results, I thought it made sense to change up our usual order of presentation and focus on the sale of Kentro and the proposed use of the proceeds, slides 6 and 8. In talking about Kentro, it's hard to avoid the conclusion that this investment and disposal is a prime example of our unique investment approach and our ability to produce bespoke investment opportunities which provide the opportunity for significant returns. As is noted, we initially acquired a 5% stake in Nexus for 1.5 million, which was then currently Kentro was previously called Nexus Underwriting Management, a profitable underwriting agency specialising in financial lines and trade credit insurance. Since then, Nexus, now Kentro, leveraging BP Marsh's experience and skill set, has completed circa 20 acquisitions and grown its revenue and profitability by approximately 10 times, with adjusted EBITDA growing from circa 2 million to north of 20 million. We will end our partnership with the management team at Kentro as the largest single shareholder in the business, having provided aggregate funding of £15 million in equity, and this will provide, upon regulatory approval, our consideration will be 51.5 million, representing a 25% IRR over a 9-year investment period. Before moving on to how we intend to utilise these proceeds, I thought it made sense to provide an overview of the recent portfolio disposals we've made, which is slide 7. As you'll note, since 2017, we've made 6 realisations, delivering equity proceeds to BP Marsh of over 93 million on equity investments of just under 27 million, so approximately a 3.5 times money multiple. I think all tangible examples of the success of our investment approach. And presentations in the past, a not uncommon line of questioning was over valuation and the ability to realise portfolio investments at our valuation. I hope this slide goes some, if not all the way, in addressing these 2 points. Turning to slide 8 and what we intend to do with the Kentro proceeds. As recently announced, we intend to return circa 13 million of the proceeds from the sale, which equates to 25%, via a dividend and share buyback policy, which will commence upon the receipt of the proceeds. We believe this rewards our shareholders for their patient support of the company, whilst also providing significant firepower for new investments and to support the existing portfolio. In terms of business strategy, slide 9, this remains unchanged, and we have an exciting pipeline of new investment opportunities, which is dealt with slightly on slide 10, which we'll have the opportunity to execute, subject to us being able to obtain satisfactory terms of investment. In point of fact, the most pressing opportunities under discussion investigation were all prior to the announcement of the disposal of Kentro. Whilst we expect an increase in new business proposals on the back of this disposal, it's our intention to maintain a measured approach to new business without the feeling of the money burning a hole in our pocket. As mentioned during previous presentations, consolidation at the bigger end of the market continues to drive significant new business opportunities, which I expect to continue into the future. Turning to new business / the ongoing portfolio, as detailed on slide 11, we completed a modest investment in Verve Risk Services, a London-based specialist underwriting agency, an area where we have good experience of and success in, and we look forward to working with the management team over the next few years to grow the business. Activity within the portfolio continues apace, and we provided follow-on funding by way of loans as follows. Slide 12, 4.9 million to XPT. As you will note, with the proposed disposal of Kentro, XPT will become our single largest investment, which is no mean feat given we invested in 2017 as a startup, and it now produces over $700 million of gross written premium across 19 offices with over 250 employees, and adjusted EBITDA for 2023 potentially exceeding 20 million. The value of our holding in this company has increased year on year by just under 13 million, or 59.5% to 34 million pounds. Turning to slide 13, we provided 0.5 million of a 2 million facility to CVC. CVC continues to deliver excellent growth as a portfolio company by both organic and new hires. This loan was provided to allow CVC to front the capital for a new underwriting agency startup, Alchemy Underwriting, which had an exceptional start to life. This benefits CVC directly by both the value of its shareholding, it owns approximately 22.5% of the business, and also the fees it receives from the provision of outsourced services and the placing commission on Alchemy's underwriting facilities. The value of our holding in this company has increased year on year by just under 10 million, or 104% to 19 million. The full insurance portfolio is set out on slides 14 and 15. Other notable performers being ATC, slide 16, and Lily Plummer Risk, slide 17, both delivering significant year-on-year growth with exceptional prospects looking to the future. In looking at the wider insurance portfolio, it's pleasing to note two facts. The majority of the value growth achieved for the 2023 financial year was predominantly delivered by the broking investments, which I would say a turnaround to recent results announcements whereby the underwriting portfolio has been the standout. I think we flagged our expectation as regards this eventuality regarding the slightly longer gestation period for brokers versus underwriting agencies, generally speaking. The second fact is that the 2023 financial year, there was negligible value uplift relating to Kentro because we knew we were going to be in the process of selling it, and we knew what our realisation value would be, and therefore the growth year on year within the NAV has been delivered by the portfolio excluding Kentro, which shows where we see the potential going forward. I think it's worth noting that we wrote off two investments during the year, EC3 Brokers and Asia Reinsurance Brokers. EC3 ultimately being faced with voluntary liquidation, COVID-19 certainly playing a major part in this unfortunate situation. A sort of BP Marsh differential / silver lining from this is that working with other portfolio companies, we were able to find employment for both front and back office staff at EC3, with a team of brokers joining Lily Plummer Risk with an immediate positive effect. Whilst we are sometimes faced with tough financial choices, we try not to ignore or avoid the human impact of these situations and try as best as we can to ameliorate it where we can. On Asia Reinsurance Brokers, while we've written this down to zero, it does continue to trade, but as ever, we believe the conservative, cautious approach is to maintain our write down while the business tries to reposition itself. Turning to the aggregate insurance position, slide 18, we've tried to show the aggregate size of the premium within the portfolio, and it's often suggested by the wider market, not by us, but BP Marsh walks softly but carries a big stick, and I think this is what they're meaning when they reference that, and hopefully we set this out in the slide. On the subject of the wider market, we've included slide 20, which sets out our very high level overview on where pricing sits on a premium basis. Property premium growth shows no signs of abatement. Whilst Broadly speaking, this is a stellar set of results for the company. It hasn't all been an unbridled success. We've had to make a significant write-down against our non-insurance investment, the financial planner LEVC, and this is detailed on slide 21. We wrote this investment down by approaching 10 million. The investment dates back to 2007, so by some margin, our longest investment, predating the majority of the team at BP Marsh, and in fact completed as I joined. To an extent, it's suffered the slings and arrows of outrageous misfortune. It's certainly a challenging area of financial services. We've gone through various rounds of management change with some strong performance along the way. Unfortunately, due to a variety of reasons, the strong performance has in some cases unwound. And we were also faced with a difficult position following the untimely death of the CEO, Jack McVitie. Notwithstanding the above, I feel optimistic as regards this investment and its management team led by Derek Miles, who continues to perform an excellent job in what has been challenging circumstances. And it does, as a business as usual, it is profitable. And I think we've worked with LEVC to mitigate some of the challenges they faced. Turning to slide 22, in drawing my presentation to a close, as I said at the beginning, we're absolutely delighted with the results achieved, thanks to our partnership with our portfolio companies. The end of our successful partnership with Kentra has drawn to a close, but as demonstrated by the numbers, the ongoing portfolio has the ability to produce further significant growth. From a financial reporting standpoint, this is again our most profitable year ever, from a PBT and NAV growth standpoint. And post-year end, we delivered our biggest ever realisation, leading to our largest ever return of capital to shareholders. The cash position is strong. We have a strong pipeline of new business opportunities, so we're in a very optimistic position. We believe Kentra will prove to be a transformational realisation for the company, which should supercharge us in looking to the future without the requirement, need or desire to change our modus operandi. As a team, we're very much excited by the future, and certainly as Chief Investment Officer, I share the sense of excitement and opportunity. Since becoming a director in 2011, I've observed or participated in significant changes within the group, which have had fundamentally positive outcomes on the company and ultimately the share price and shareholder returns, which in the long run is the scorecard for us as a listed business. Looking to the coming years and decade ahead, I see the same potential, if not greater. Before handing on to John, and hopefully repeating myself for the final time, all of this could not be achieved without the team at BP Marsh and our portfolio partners within the portfolio. So I'm particularly grateful. The team's got good experience and a good skill set, from Brian Marsh as chairman to Patrick McNamara as a recent joiner. I think we're all delighted with the results we've achieved and invigorated looking to the next coming years. I can now hand over to John to talk through in more detail his thoughts on the financial KPIs within our results, and after which we can close out the presentation with any questions anyone may have.
Thank you, Dan. So I'm pleased to present the key financial highlights for the year to 31st of January 2023. So overall, NAV increased by 22.9 million or 13.8% for the year, and now stands at 189.5 million. That's equivalent to 526.2 pence per share, or 516.8 pence on a diluted basis, and that's in relation to shares that the management team have within a JSOP arrangement. So this equates to a total shareholder return of 14.4% for the year, including the £1 million of dividend that was paid in July of 22. Overall, the group delivered consolidated profit before tax of 27.6 million for the year, up 8.2 million or 42% over the prior year. The majority of their profit relates to the increase in valuations of the investments, as Dan's covered, with the equity portfolio rising by 19.1%, adjusting for additions of realisations to 171.5 million. Circa 3% of the return in the year related to foreign exchange gains on the investment portfolio due to the pound weakening. For the segmental reporting section of our accounts, which you may have seen, which is based upon where our investments are domiciled, 37% of our equity investment portfolio by value is overseas versus 63% in the UK. However, on a look-through basis, based on where the revenues actually originate from, it's actually the opposite. Approximately 63% of the portfolio is overseas. One of our core strategies is to seek to ensure that the yield from our portfolio covers our operating expenses, so that our investment cash doesn't get depleted by working capital. On an underlying basis, this was achieved with a PBT of 0.3 million for the year. Last year, it was 3.2 million, but that included 2.9 million in realised gains on disposal, mainly from the sale of Walsingham, So otherwise, year on year, it's comparable. Final dividend of 1.39 pence per share, or £500,000, has been proposed to be paid in July 23, bringing the total distribution for the year to 2.78 pence per share, or £1 million, including the £500,000 that was paid in February 23. That was in line with the prior year. So on to slide 24. Since flotation, the group has achieved compound growth of 8.7% and 11.7% since inception. That's after all expenses, tax and distributions, and excluding any capital raise. So this slide sets out the key investments, realisations and loan portfolio movements during the year. We've invested 2.9 million in equity, 2.8 million in follow-on funding into XPT in the US, and 0.1 million into a new startup investment of Denison Partners. We also received 8.2 million in proceeds from realisations during the year, some of which we announced at the end of the previous year, completed in March, delivering net equity proceeds of 8.1 million. And we also received additional 0.1 million in funds from the sale of MB that actually occurred in 21. Turning to the loan book, this stood at 11.5 million at the year end, compared with 10.4 million at January 22. We granted 2.7 million in new loans during the year, 1.5 million to LEBC for an acquisition, 0.7 million to AgGuard for working capital, and 0.5 million to a new investment, Denison Partners. 1.7 million of loans were repaid during the year. The majority of this 1.5 million was from Summer on completion. Given that we don't set exit clauses and are a medium to long-term investor with an average holding period of over 7 years currently, we often structure our investments as a mixture of debt and equity, though not just debt. And this enables a yield to be received on the investment to cover our operating costs, and the debt repayments help to replenish capital funds rather than having those funds tied up until an eventual exit. There is a slide in the appendices on, I believe, slide 30, that sets out the loan book in full, and all are valued at par. The average interest rate charged for the year was 8.6%. That was up from 6.9% in the previous year, and reflects the increase in base rates that has occurred over the period. At the year end, we had 12.1 million in cash, up from 8.6 million at the previous year end, with the increase due to the summer realisation, less the net loans granted, new investments, and the £1 million of dividend that was paid. So based on the current share price of 370 pence per share, this means that we're at a current discount to diluted NAV of 28.4%. So following slide, there have been a number of significant developments since the year end. In January, we announced a £1 million share buyback policy, and to date, we've bought back over 103,000 shares for circa 330,000 at an average price of 319 pence per share. On the current diluted value of 516.8 pence per share, we would value those at 533,000, so sort of 62% up on that. In May, we announced the agreed sale of Kentro, subject to regulatory approval. We should provide 51.5 million in cash net of transaction costs. We've also provided, since the year end, 4.6 million in net new loans, of which 4.9 million was lent to XPT to enable further acquisitions, of which 0.8 million has subsequently been repaid. As Dan mentioned, 0.5 million to CVC as part of a new 2 million facility to fund a new startup London property MGA. We also announced we've invested 1 million in a new investment, Verve, in a mixture of equity and debt. Current cash is 5.2 million, but is expected to increase to over 56 million on completion of Kentro. As Dan has set out, the proposal is then to distribute 25% of the proceeds, 7 million via dividends over 3 years, and a new 6 million share buyback policy. So turning to slide 26, to summarise the position, why invest in BP Marsh? We're a leading specialist investor with an excellent track record and team with a wealth of experience. Although we specialise in financial service businesses with a specific interest in insurance intermediaries, our portfolio is diversified in terms of product lines and geographically mitigated risk. We've achieved 8.7% compound growth since flotation, 11.7% since inception, after all expenses, realisations, distributions, and that's through identifying excellent growth opportunities and delivering added value and return to shareholders, as demonstrated by growing the NAV to 189.5 million. When Kentro completes, we expect to have over 56 million of cash pre-distributions. We've demonstrated that we can successfully realise investments at or above prior valuations, with strong exit performance over the last 18 months with cash sales of Walsingham Summer and now Kentro. This has provided the opportunity to return 25% of the expected Kentro proceeds, rewarding shareholder loyalty whilst providing significant cash to fund both new and existing opportunities. We consider the current discount to diluted NAV of 28.4% to be unwarranted. So this concludes our formal presentation. I will hand back over to IMC to invite any questions that you may have.
That's great. Dan, John, thank you very much indeed for your presentation this morning. And if I may, I will just bring back up your camera there in the room. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. John, Dan, as you can see, we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. Simon, if I may hand over to you to chair the Q&A session with the team, and then I'll pick up from you at the end. Thank you.
Thanks, Jake. Let's start with a pre-submitted question. There's always been a substantial discount to NAV. Is the buyback program going to make an appreciable difference? And what other measures have been considered to reduce the discount to NAV?
Well, there has been a significant discount to NAV, the share price. I think certainly the buyback is, attempt to go some way to address that. Time will tell if it does make an appreciable difference. We certainly think it hopefully should. In terms of what we've considered, we've got a sort of parallel smaller share buyback where we've used that to try and manage the discount as best we can. But everything is under consideration to manage the discount from, dividends, which we've increased, and clearly with realizations, we seek to continue a meaningful distribution of sale proceeds. I think, with the Kentro realization, we're going to return 25% to shareholders, whilst we're not going to impose any rules on disposals. I think that's a fairly decent starting point to have a 25% return to shareholders, as the best way possible for the shareholders, and that should hopefully have an impact on the discount to share price and NAV, or NAV to share price. I think there'll always be a natural discount, but it's our job to try and make that natural discount as small as possible.
I think I'd add to that, delivering on results. We've seen a sort of almost 20% increase in the share price over the last month since we announced the Kentro disposal and delivering that. And it's, continuing to prove, what we always set out.
Thanks, guys. Pursuing that idea a little bit further, question from Alex. Can we expect to see further realizations following the same path as the Kentro sale? And Dan, I think you've already partially answered that one, in returning cash to shareholders. And do you see this this strategy as a catalyst to attract new investors?
I think whilst not setting a hard and fast rule, certainly that's what we think makes sense in terms of distribution to shareholders. What we've done with Kentro, and certainly I would hope it is a catalyst to attract new investors, giving them the opportunity to invest in a very strong portfolio that delivers outsized results.
Okay, a couple of questions on new opportunities and new investments. In terms of balancing new investments and cash returns, do you have a defined metric of how you how you divide those two? And
No.
Could you identify a little bit further and expand on the pipeline of new investments that you've got, and how specifically do you identify new opportunities?
On the metric, no, we're more flexible than that. But I think regardless of the cash position, we're not going to change our investment approach in terms of the target deals that we're looking at. We do have a good inflow of deals in our bailiwick, in that sort of 0 to 5 million investment gap that we detail in the appendix on the presentation, and that's certainly not slowing down. I think what we do like to do is follow our money. We've got, generally speaking, a very successful track record of that. So whilst not changing our new business approach within the portfolio, we've got significant areas where we can deploy that capital. And look, using Kentro as an example for an exit investment, we started with 1.5 million committed, and we've gone to 15 million, which was our biggest. And then looking within the portfolio, XBT isn't far behind and has achieved a great deal. So we will, continue to deploy investments into XBT, I would imagine, should the right proposals come through, which I suspect they will. And then the other part of the question, the new opportunities. I think we don't participate in auctions like mid-market private equity do. Reputationally, we feel we've developed a very good reputation within our area of operation, and we continue to see people coming to us as the capital provider of choice in insurance distribution businesses, and certainly that's evidenced by our results from a quantitative standpoint. We are, I would say, unique in funding flexibility and provision of funding such that people come to us on reputation, and we are the only game in town.
Thanks, Dan. Thanks, John. There are no more questions, and I'll hand back to Jake.
Thanks, Simon, and Dan and John as well. Thank you very much indeed for being so generous with your time and addressing those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the Investor Meet Company platform. But Dan, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
No, thank you very much. And firstly, thanks for everyone who's attended this call. We really welcome people learning more about the business. We like to tell the story. We think it's an exceptional story of what we've achieved and the opportunities for what we can achieve going forward. I think this set of results demonstrates that, and we certainly feel very confident and comfortable of what we can and will achieve going forward next 6 months, next 12 months, next few years to expand on the performance of the portfolio. So thanks for people attending, and just to thank everybody at BP Marsh for all they've done in what we've achieved and continue to achieve. And if there are any, if people do have any questions after the fact, please by all means get in and Investor Meet, because we will address every question raised either during the meeting or if it's raised after the meeting. So please, if anything pops into your head, do get in contact.
Dan, that's great. And John as well, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of BP Marsh Partners PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.